The most widely used indicator for spotting overbought, oversold, and other market conditions like possible reversal zones is the RSI. Despite being a widely used indicator, the RSI has some significant flaws that make it unreliable in particular market circumstances. The most important one is that because the RSI only takes price movements into account, it might not correctly reflect changes in volume and market momentum. This may lead to erroneous signals and shaky trading choices. Fortunately, there's another indicator that can be used instead of the RSI indicator, called the money flow index. Because it considers both price and volume, the money flow index is a much better predictor of market momentum. This is so that traders can recognize major price movements before they happen by taking the market's volume into account, which gives the MFI a more comprehensive picture of the market sentiment. Let's first look at how the money flow index functions and how we can use it since it differs slightly from the RSI indicator in its operation. We can calculate the raw money flow by multiplying the typical price, which is the product of the high, low, and close split by 3, by the volume. The 14-period positive money flow is then split by the 14-period negative money flow to determine the money flow ratio. The money flow index is then computed by deducting 100 from 100 and dividing the result by the money flow ratio plus 1. The money flow indicator is determined in this manner. Now that you are aware of this and how the money flow index incorporates volume, let's look at how we will interpret the indicator. Let's start by charting the signal. Go to the Indicator Search tab and look for the Money Movement Index indicator there to do this. Choose the Trading View indicator, then add it to the screen. Let's alter the indicator's colors to make it more noticeable now that it has been introduced to the chart. To do this, select the Style tab under the indicator settings. The Money Movement Index line's color will be changed to white. After that, we'll get rid of the supporting stories. We've completed everything we needed to. Let's look at how to interpret the indicator now. The overbought line, oversold line, intermediate line, and money flow index line are the 3 lines that make up the money flow index indicator. Let's go over a few of the numerous methods the money flow index can be read. It's critical to pay attention to the MFI's worth in order to understand what the money flow index is really saying. The market is regarded as overvalued whenever the money flow index reading exceeds 80. This indicates that there will be a strong likelihood of a bearish pullback if the MFI value is higher than 80. Additionally, the money flow indicator is regarded as oversold whenever it falls below 20, indicating that there is a strong chance that a positive pullback will occur. As you can see, the indicator does in fact function quite well when using this straightforward approach. However, we can also see that there are instances where the market is overbought but still soars, or when it is oversold but still falls. For this reason, it's crucial to incorporate other technical analysis tools or indicators with the money flow index in order to develop a profitable trading strategy. Let's look at the second method to read the money flow index indicator first before we examine such a strategy. We will contrast the MFI with the price action when using this technique. It can be interpreted as a sell indication if the price makes a higher high while the MFI makes a lower high, because this shows that the trend is weak. However, if the price makes lower lows while the MFI makes higher lows, this may indicate that the downtrend is weakening and is a good time to initiate a buy position. Now that you are fully aware of how to understand and apply the money flow index, let's look at a successful trading method to pair it with. First, let's include an additional sign on the chart. Look for the exponential moving average under the indicator search option. The indicator created by TradingView will be added to the display. Let's now modify the indicator's parameters to make them more effective for the strategy. Click on the Inputs option under the Indicator Settings tab. The EMA's duration will be increased to 200. Let's now alter the indicator's design as well. To accomplish this, select the Style tab and then alter the EMA line's color to yellow. That was all there was to it. Let's now examine when to use this strategy to initiate a buy position. First, the money flow indicator must drop below 20, which qualifies as an oversold condition, for it to become oversold. If the market is oversold, it means that the commodity is being sold for less money than it is actually worth. The price must make lower lows, while the MFI must make greater lows, for this to happen. If this is the case, a positive divergence has taken place. When this occurs, it demonstrates to us that the bears are losing ground and that the short-term decline in this instance has weakened. Additionally, We must ensure that the price is trading above the 200-period EMA in order to ensure that we are not engaging in a trade that is contrary to the larger pattern. If all of these requirements are satisfied, we will then take a purchase position. To determine the precise moment at which we will take this position, we will watch for the price to break through a resistance area. As you can see, a resistance line was broken and the price closed above it. Let's take the trade because this will indicate that the downtrend has been broken and that a bullish trend is about to begin. At the most recent swing bottom, we will set the stop loss. For the take profit, we will aim for a risk-to-reward ratio of at least 2, or a market position just below a zone of resistance that also offers a risk-to-reward ratio of at least 2. Let's now watch to see how the deal turns out. The following requirements must be satisfied for this strategy to engage into a sell position. First, we must wait for the money flow index to overbought, which calls for the indicator's value to rise above 80. The price must make greater highs, while the MFI must make lower highs, for this to happen. If this is the case, a negative divergence has taken place. When this occurs, it demonstrates to us the weakening of the short-term uptrend and the diminishing influence of the bears. We must also ensure that the price is trading below the 200-period EMA in order to ensure that we are not engaging in a trade that is contrary to the larger pattern. We will take a sell stake if all of these criteria are satisfied. We will need to see the price breach a support zone in order to determine the precise moment at which we will open the position. As you can see, a support line was broken and the price closed below it. Let's take the position because this will indicate that the uptrend has been disrupted and that a bearish trend is about to begin. We will be setting the stop loss at the recent swing high. For the take profit, we will aim for either a market point directly above a support zone that also offers a risk-to-reward ratio of at least 2 or a risk-to-reward ratio of 2 times. Okay, so now that you know the trading setup, let's actually do our backtest on a 5-minute time frame and see if the outcomes are reasonable or not. I just finished the backtesting, and these results have surprised me. Our win rate is 70%, and the profits end up at 11%. I would also like to mention that these results will be different when trading live, so always try the strategy for yourself before using it. Guys, feel free to run back and forward testing on various markets and times to gauge how well it performs. If you want to see one of my other trading strategies I use when day trading, check this video right here, because this strategy works great on the every time frame you want. I'll see you guys next time.